Business organizations, Limited Liability Companies, LLCs. An LLC is a hybrid combining features of a corporation with features of a partnership. Like a corporation, the LLC provides a liability shield for the owners. The owners are not held personally liable for the debts of the LLC. Like a partnership, the profits flow through the LLC to the individual owners where they are taxed. The profits are not taxed when they pass through the LLC, then taxed again when the owners file their own personal tax returns. Also, like a partnership, the LLC is not incorporated with the state. This hybrid, combining limited liability with pass-through taxation, is very appealing to many business owners, and LLCs have been formed to replace many sole proprietors, partnerships, and limited partnerships. Fewer corporations have been transformed into LLCs, as the corporations already have limited liability. Corporations can find creative ways to minimize their taxes, and transforming a corporation is often a much more arduous task, as approval is required from numerous shareholders. In the United States, the first Limited Liability Company Act appeared in Wyoming in 1977. In 1980, the Internal Revenue Service issued a ruling that it would treat the LLC as a partnership for federal tax purposes. Then later that year, the IRS changed its position, denying partnership status unless one owner had unlimited liability. As a result, between 1980 and 1988, there was uncertainty over tax treatment and little momentum behind the LLC in the US. In 1988, the IRS resolved the uncertainty and decided to treat the LLC as a partnership. This meant the owners of the business could gain limited liability and avoid the double taxation they were accustomed to under the corporate form of business. Between 1988 and 1996, almost every state had responded to the demand for the LLC and enacted their own LLC statutes. The National Conference of Commissioners on Uniform State Laws adopted the Uniform Limited Liability Company Act in 1996 and revised it in 2006. LLCs use a different terminology to corporations and partnerships. The term member is used instead of partner or shareholder. The term membership interest is used instead of share or partnership interest. The term manager is used instead of president or CEO. Although the LLC is not incorporated, its existence needs to be registered with the Secretary of State or some other government body. The term Articles of Organization is used instead of Articles of Incorporation, as they're used in a corporation. The term Operating Agreement is used instead of Bylaws or Partnership Agreement. The operating agreement of an LLC determines, defines, and apportions the rights of the members and the managers. The operating agreement generally is not filed with the Secretary of State or any other governmental office. The operating agreement addresses matters of formation: the name and purpose of the company, its place of business, and the term. An LLC can be formed for a fixed period of time or to exist indefinitely. The operating agreement defines how the members invest their capital contributions, what happens if contributions are unpaid, and addresses membership certificates, etc. Owners do not receive share certificates as they would in a corporation, but the operating agreement can provide for them to receive membership certificates. Members, the owners of an LLC, can be corporations, partnerships, and other business organizations. The ownership is not restricted to individuals. The distribution of profits, losses, and tax allocation is obviously an important set of issues that need to be carefully defined in the operating agreement. So is the allocation of control to managers. LLCs may be managed by their members in proportion to their membership interests. Many LLC operating agreements, however, provide for a manager or board of managers to oversee or run the day-to-day operations of the LLC. The managers are elected or appointed by members and may also be, if so provided in the operating agreement, removed by the members. A member may also be a manager, often called the managing member. Like a partnership agreement, the operating agreement of an LLC can be completely customized to meet the requirements of the members. Unlike a corporation, it's very important the operating agreement of an LLC is fully formed. The default rules controlling the operation of a corporation are well established, but those of an LLC are still unclear. Where the operating agreement is silent, it's sometimes unpredictable as to how members' and managers' rights will be determined by the courts. The LLC's advantage over a corporation is the ability to avoid double taxation. The owners pay tax on the profits passed through to them individually, and the LLC does not. Furthermore, profits and losses can be assigned. The ownership of membership units can be separated from their economic benefits. While ownership of a membership unit rests with one individual, the losses and profits can be passed to the members and individuals with a view to maximum tax efficiency. Compared to corporations, an LLC can be more easily created and managed. Boards of directors, multiple owners and managers are not required. An LLC can be owned and managed by a single individual. The LLC is not incorporated with the state and can require less administrative paperwork than a corporation. Whereas creditors of a corporation can often pierce through the corporate veil and hold shareholders liable for the debts of the corporation, the courts have resisted many such attempts with LLCs. The liability shield of an LLC is particularly strong. The LLC cannot be pierced like a corporation, and the members cannot be named in a lawsuit for failure to hold board meetings or follow certain formalities. The most obvious disadvantage to the LLC for many small business owners is the state franchise tax that's levied on LLCs but not on corporations. As an example, in California, the cost is currently $800 a year. Entrepreneurs looking to raise funding from venture capital and other investors often find an LLC impossible to finance. The investment community has grown to understand and feel comfortable with the business framework provided by the Delaware Corporation. They understand the rights provided to investors and the way disputes between investors and shareholders are handled by the specialist chancery courts in Delaware, and the LLC is not yet popular with the mainstream venture capital community. However, in Hollywood the LLC has become a popular vehicle for financing studios as well as individual movies, and we may see the LLC catch on with other investors in future. Other members of the business community, such as advisors, banks, finance companies, and other credit lenders, are still somewhat unfamiliar with LLCs. They understand corporations. All their forms and business practices are oriented towards dealing with corporations, and they are easily confused when presented with an LLC. The states are inconsistent in how key features of the LLC, tax treatment and limited liability, are handled. Before forming an LLC in a particular state, it's important to check the state's policies in these areas, as well as the annual franchise tax the owner can be expected to pay. When a corporation is formed, a set of default rules defines the rights and duties of the shareholders, the board of directors and management. Unless and until the corporation displaces these default rules with its own set of bylaws, the rights and duties of the stakeholders are well defined and understood. This is not the case with the LLC. Forming and operating an LLC without a clearly defined operating agreement can be problematic, as there can be considerable confusion as to the rights and duties of the members and managers. A professional limited liability company, a PLLC or PL, is a limited liability company organized for the purpose of providing professional services. Usually professions where the state requires a license to provide services, such as doctor, chiropractor, lawyer, accountant, architect, or engineer, require the formation of a PLLC. Exact requirements of PLLCs vary from state to state. Typically, a PLLC's members must all be professionals practicing the same profession. The limitation of personal liability of members does not extend to professional malpractice claims. A Series LLC is a special form of a limited liability company that allows a single LLC to segregate its assets into separate series. For example, a Series LLC that purchases separate pieces of real estate may put each into a separate series, so if the lender forecloses on one piece of property, the others are not affected.